Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, we are from Group 5. We will present our presentation now, and before that, let me introduce our members. First, myself, Nafila Sabila Sadra, and then
My name is Alifah Kamila.
and then
Me, Muhammad Islam Mutangkiari.
and two else our member is Sandra Hafiz and Arifah Arwah. So, stay tuned.
The first one, we will talk about the income statement. The first topic is the definition of the income statement. An income statement is a report that ensures the success of the company operation for a given period of time. It's also often called as a statement of income or statement of earnings. The business and environment community uses the income statement to determine profitability, investment value, and creditworthiness. It provides investor and creditors with information that helps to predict the amounts, timing, and uncertainty of future cash flows. Next, we will talk about the usefulness of the income statement. The first one is evaluate the past performance of the company. Examining the revenues and expenses indicates how the company performed and allows comparison to its competitors. For example, the two competitors in the same business, like Hyundai and Toyota, that make an analysis to use the income statement to provide it and compare the performance of the both companies. The second one is provide a basis of predicting future performance. Information about past performance helps to determine important trends, which, if they continue, provide information about future performance. For example, a company that reported consistent increases in revenue, obviously, a success doesn't necessarily translate into future success. And the analyst can predict better about the future values, earnings, and cash flows if a reasonable correlation exists between past and future performance. The last one is helps assess the risk or uncertainty of achieving future cash flows. Information on the various components of income, revenue, expense, gains, and losses highlight the relationship among them. It also helps to assess the risk of not achieving a particular level of cash flows in the future. For example, the investors and creditors of considered segments operating performance from discontinued operation because segments primarily generates revenue and cash through its operation. Next, we will talk about the limitation of income statement itself. The first one, on the right side, is the company's own system from an income statement that they cannot measure reliably. Current practice prohibits recognition of certain from the determination of income, even though the effect of these items can arguably affect the company's performance. For example, a company may not record income unrealized gains and losses on certain investment securities when there is uncertainty that it will ever realize the change in value. The next one is income numbers are affected by the accounting methods employed. As we know, there are two methods in accounting to calculate the accounting system. There are the accelerated basis and the straight-line depreciation. So if two companies, for example, use the different method to calculate their financial statement, it will be the different result in the income result. The next one and the last one is the income measurement useful to judgment. For example, one company in good faith may estimate the useful of life of an asset. There are the different assumed between each company. For example, the first company assumed in 20 years and the other one is assumed in 15 years. It will be the different nominal for the asset cost, and will back that expense, and the result in lower expense and higher income. One plus topic in our research review is about quality of earnings. Earnings management is often defined as the planned timing of revenues, expenses, gains, and losses to smooth out bumps in earnings. In most cases, Companies use earnings management to increase income in the current year at the expense of income in future years. And companies also use earning management to decrease current earnings in order to increase income in the future. Companies establish these reserves by using unrealistic assumptions in estimate liabilities for such items and environmental liabilities, restricting charge and royalty returns. The companies then reduce these reserves to increase reported income in the future. Managing earnings up or down adversely affects the quality of earnings. And the research concludes that many companies tweak quarterly earnings to meet investor expectation. Another recent study reinforced the concerns about earnings management. The study concludes that high-quality earnings are sustainable when backed by actual cash flows and when they avoid unreliable long-term estimates. However, about 20% of firms manage earnings to misrepresent their economic performance. And the next presentation will be presented by Safira. Safira, the time is yours.
Okay, the second material is content and format of the income statement. The first we must to know is elements of financial statement. The first one is income. Income is increases in asset or decrease in liabilities that result in increases in equity, other than those relating to contribution to holders of the equity claims. The definition of incomes include both revenue and gains. The difference of revenue and gains is revenue arises from the ordinary activities of a company and take many forms, such as sales, fees, interest, dividends, and rents. The gains represent other items that meet the definition of income and may or may not arise in the ordinary activities of a company. Gains include, for example, gains on the sale of long-term assets or unrealized gains on trading securities. The second one is expense. Expense are decreases in assets or increases in liabilities that result in decreases in equity other than those relating to distribution to holders of equity claims. The definition of expense includes both expenses, expense and loss. The difference between expense and loss are expenses generally arise from the ordinary activities of a company and take many forms such as cost of goods sold, operational selling, renting, salaries and wages, and taxes. Loss represent other items that meet the definition of expense and may or may not arise from the ordinary activities of a company. Loss include loss on restructuring charges, loss related to sale of long-term assets, or unrealized loss on trading securities. The next one is intermediate component of the income statement. Like you know that the first one is sales of revenue section, the second one is cost of goods sold section, gross profit, and the third one is selling expense, administrative general expense, other income and expenses, financing costs, income tax, discounting operation, non-controlling interest, and administration. The next one is the formula of income statement, like sales. The first one is sales revenue. We define it to less sales discount and sales related and allowance. So we find the sales. So to find the cost of goods sold, we must define sales and not sales. So we find the cost of goods sold. Cost of goods sold, and we define gross profit. Then we divide it with selling expense, administrative expense, and other income and expense. So we find the income tax. The next one is in some cases, an income statement cannot possibly present all the desired expense detail to solve this problem. A company includes only the total of components in the statement of income. It then also prepares supplementary schedules to support that total. This format may reduce the income statement itself to a few lines on a single sheet. This is the example of condensed income statement. Thank you. The next period is present by Nafisa.
Okay, for next material will be presented by me. The title is reporting various income items. Okay, first gross profit. Gross profit is composed by deducting cost of goods sold from net sales. As a result, analysis can more easily understand and assess trend in revenue from continuing operation. Similarly, the reporting of gross profit provides a useful number for evaluating performance and predicting future earnings. And the second one is income from operation. Income from operation determines income from operation by deducting selling and administrative expense, as well as other income and expense from gross profit. Income from operation highlight items that affect regular business activities. And next, expense classification. First, expense is classification by two types. First, by their nature, such as cost of materials used, direct labor incurred, delivery expense, advertising expense, employee benefits, depreciation expense, and last amortization expense. And second one is by their function, such as cost of goods sold, selling expense, and administrative expense. An advantage of the nature of expense method is that it's simple to agree because allocation of expense to different functions are not necessary. The example like service like this, there is one service revenue, cost of service like staff salary, supplies expense, and then selling expense like advertising cost, entertainment expense, and last administrative expense like utilities expense. And if you use nature of expense, you will put there service revenue, staff salaries, supply expense, advertising cost, utilities expense, depreciation on building, entertainment expense, and net income. So will be this. And if you use function of expense, will like this: service revenue, cost of service, selling expense, and administrative expense, and you will get the net income. So next, gains and losses. Developing a framework for reporting these gains and losses is important to ensure reliable income information. Any gain or loss experienced by the company, whether directly or indirectly related to operations, contributes to its long-run profitability. In general, the DISB takes the position that both revenues and expenses and other income and expense should be reported as part of income from operation. Okay, next. The third one is income before income tax. Book how computes income before income tax by deducting interest expense after regard to as financing cost from income from operation. Under IFRS, companies must report their financing cost on the income statement. The reason for this requirement is to differentiate between a company's business activity and its financing activities. Fourth is net income. Book how deduct income tax from income before income tax to arrive at net income. Net income represents the income after all revenues and expense for the period are considered. It is viewed by many as the most important measure of a company's success or failure for a given period of time. And the fifth is earnings per share. A company customarily sums up the result of its
income. The formula is net income minus preference dividends divided by the weight average of ordinary share outstanding equal to earning per share. So in this example is 350,000 minus 50,000 per 1,000 equal for 3. So the 6 is this discontinued operation. As discussed previously, one of the most common types of unusual item is the discontinued operation. The EFSB defines a discontinued operation as a component of an entity that either has been disposed of or is classified as held for sale. And first, represent a major line of business or geographical area of operation, or second, is part of a single coordinated plan to dispose of a major line of business or geographical area of operation, or third, is a subsidiary acquired exclusive with a view to result. And for the last, is allocation to non-controlling interest. A company like Sims, they own substantial interest in other companies since they generally consolidate the financial result of these companies into its own financial statement. In this case, Sims is referred to as the parent and the other companies are referred to as subsidiaries. Non-controlling interest is then the portion of equity or net assets. In the interest in a subsidiary not attributable to the parent company. So that's of me. For the next material will be presented by my friend for Afifa. Thanks yours.
So, present accounting changes and errors. There are two types of accounting changes. It's change in accounting principle and change in accounting estimate. The first one is change in accounting principle. The change in the method of inventory pricing from FIFO to average cost, or the change from the existing accounting principle to a new accounting principle. Important thing is they must demonstrate that the principle is preferable to the old one. To recognize the change in the accounting principle, we make a retrospective adjustment to the financial statements. So here, to illustrate, we have Gobert A company which began operation in 2020, decided in March 2022 to change from FIFO to weighted average inventory pricing. Gobert's income before income tax using the new weighted average method is 2020. At 2020 is $3,000. So here we have year 2020 and 2021. With the FIFO method, we have $4,000, and at 2021 we have $3,000. For the weighted average method, we have at 2020 is $3,500, which excess of FIFO over weighted average method, we have $500. So at the 2021 we have weighted average method and $2,700, which excess of FIFO over weighted average method for $300. So the total of excess of FIFO over weighted average method is $800. So here we have income statement presentation of a change in accounting principle. Here we have income before income tax. We have different comparison between 2020, 2021, and 2022. So we can see it. So I will explain what retrospective means. Retrospective means that we have to use the method, the newly method, to the prior year that we already calculate for the old method. Okay, next. So the second one is change in accounting estimate. Inherent in the accounting process. For example, companies estimate useful lives and residual values of depreciable assets and collectible receivable, inventory obsolescence, and the number of periods expected to benefit from a particular expenditure. Not infrequently, due to the passage of time, circumstances, or new information, even estimates originally made in good faith must to be changed. To recognize a change in accounting estimate by making a prospectively adjustment to the financial statement. Here to illustrate, assume that DPage company consistently estimate its bad debt expense at 1% of accounts receivable. In 2021, DPage determines that it must revise upward the estimate of bad debts for the current year's credit sales to 2%. The 2% rate is necessary to reduce account receivable to net receivable value using 2% results in the bad debt charge of $240 or double the amount when the result in bad debt charge of the amount using the 1% estimate for prior years. The page records the bad debt expense and related allowance December 31, 2022 as well. So for the change accounting, we estimate we use it prospectively that we use it for the future. We think about the future. So here is how to calculate it. Next. So next one is accounting errors. Accounting errors occur as a result of mathematical mistakes, mistake in application of accounting principles, issues of facts that existed at the time financial statements were prepared, and any other mistake intentionally or unintentionally. So, companies correct errors by making proper entries in the accounts and reporting the correction in the financial statement. Correction of errors and treated as prior period adjustment. Here to illustrate, in 2022, some Ltd determined that it incorrectly overstated its account receivable and sales revenue by NT $100 in 2021. In 2022, some makes the following entries correct for this error. Ignore the numbers. Here to calculate it. So return earning is debited because sales revenue and therefore net income was overstated in a prior period. Account receivable is credited to reduce this overstated balance to the correct amount. Okay, maybe that's all from me. Thank you very much.
And now I want to present next to be continued by me. Now I want to tell you about the income statement and the related information from akuntansi keuangan by the books. Next. And the statement of the financial position is first the benefit of the statement of the financial position, second limitation of the statement of the financial position, third installments and format of the statement of the financial position. Next. A benefit of the statement of the financial position. Next. The statement of the financial position is used as the basis for calculating the rate of the return of investment and evaluating an entity's capital structure. Liquidity is the time it takes to convert asset to cash or the time it takes to pay off the liabilities, and solvency is the entity's liability to pay long-term debt when they fail to accounting circle. First, identify transaction and events. Second, journal entries. Third, post the ledger. Fourth, preparation of trial balance. Fifth, adjustment. Sixth, trial balance after adjustment. Seventh, preparation of financial reports. Eighth, journal closing, and in the end, nine is reversing journal. Next. The limitation of the statements of the financial position. Next. First, as the asset and liabilities are recorded and historical costs. However, Under current GAAP, companies are required to present asset at fair value at the financial reporting dates to overcome this limitation. Second, the company uses judgment and estimates to determine the value of the items reported in the statement of financial position. And third, the statement of the financial position limits the many elements of the statement of the financial position that have financial value but entities cannot record them objectively. However, because Intel cannot really measure the value of its employees and intangible assets such as reputation of customer service, they cannot be recognized in the statement of the financial position. Next. See, we're talking about the elements and the format of the statement of the financial position. Next. Asset. We know that assets are the future economic benefits that are probable to flow the entities as the result of the past transaction or events. And liabilities are probable features revised of economic benefit are arising from present obligation of the entity to transfer asset or provide a service to another entities in the future as a result of the past transaction or events. Equity is the owner's interest in the asset of the entity after dedicating all liabilities. The presentation of the following items. First is the fixed asset. Second, the investment property. Third is intangible asset. And fourth is financial asset such as investment in the security and so on. The items in the statement of the financial position are classified as same items are grouped together so that the subtotal is obtained. Next. Short-term liabilities and long-term liabilities. First, the debt is the result of the purchases of the goods and services such as trade, payables, salaries debt, tax payable, and others. Second, the entity will settle the liabilities within its normal operating circle. And third, the entity has liability for trading, proposal, or false. The liabilities are due to be settled within 12 months after the reporting period. And fifth, the entities does not have the unconditional right to postpone settlement of the liabilities for at least 12 months after the reporting period. In the short term, liabilities, these events must be disclosed as non-adjusting events. And first, the long-term based refinancing. Second, recognizing of the violence of the long-term loans agreements. And third, providing a grace period for payments by the use of correct violence of the long-term loans agreements that end at the least 12 months after the reporting period. Next. Okay. Liabilities that are not included in the above categories are classified as long-term liabilities. Financial liabilities that are long-term financial, not part of the working capital used in the normal operating circle, and are not due within 12 months after the reporting period and concern long-term liabilities. If the entity expects and has the right to reference the revenue, the liability for the minimum of the 12 months after the reporting period using the existing loan facilities, if the refinancing is not at the discretion of the entities. For the example, there is not agreement to refinancing, then the entities does not consider the possibility of the refinancing liabilities, then distinguish short-term liabilities. Next. Now we're talking about the statement of the profit and loss and other comprehensive income. First, the benefit of the profit and loss report. Second, the limitation of the profit and loss report. And third is the element of the profit and loss statement. and fourth is format of the profit and loss reports, and fifth is the unusual profit and loss operation, stock, non-controlling interest, and profit per share. Next. A benefit of the profit and loss report. Performing information also help investor and creditors predict earnings, profit, and the future cash flow by studying the trend and assessing the risk of not achieving the expected cash inflows. X. Limitation of the profit and loss report. First, the company elimination terms that cannot be measured by liabilities. Second, the profit is affected by the accounting method used. And third is the measurement of the profit using the judgment. Next. Elements of the profit and loss statement. First, we're talking about the revenues. Revenue is the income or increase in the asset or increase in the liabilities during an accounting period or getting from the delivery of goods and services or other activities related to the entities and activities. And second is talking about the expenses. Expenses are expenditure or reduction in the asset or the increases in the liabilities originating from the delivery of goods and services or other activities related to the main activities the entity. And third is advantage. Or we're talking about the gains. Gains are increases in equity originating from the transaction outside the entity's main activities, except for those originating from the investment or income, such as the gains on the sales of the fixed asset or gains on the sales of investments. And fourth, we're talking about losses. The losses are the decreases in equity originating from the transaction outside the entity's main activities, except for those originating from the capital investment or expenses, such as asset disposal due to the damage or these assets. Next. We're talking about element of the profit and losses statement. Items represented in the statement of the profit and or loss and other comprehensive income include: first, income; second, financial cost, compared with the share of the profit or loss of association and joint ventures, which are accounted for using the equity method. Fourth is the tax burden. Five is a single amount that includes the total of first, the profit or loss after tax from discontinued operation, and B, the gains or loss after the tax are recognized by the measuring fair values list cost to sell or dispose of asset in the context of this continued operation. And six is profit and loss. Seven, we're talking about each component of the other comprehensive income classified according to its nature, and eight, the version of the comprehensive income of association and joint ventures, which are the continued accounted for using the equity method, and nine, total comprehensive income. Next. We're talking about the format of the profit and loss report. Presentation of the additional items, styles, and others amount in the statement of the profit and loss and the other comprehensive income and spared in the statement of the income if presented is possible if such as presentation is relevant to an understanding of the entity's financial performance. Entities are not permitted to presentation income and expenses items as extraordinary items in the statement of the profit or losses and other comprehensive income. As stated, the statement of the profit or loss if the presented of or in the notes to the financial statement. In the nature of the expenses method, there are only the two classification groups, namely the income and expense. Next. In the next, we continue in the expenses function method, cost of the sales, expenses are classified based on their function as part of the cost of sales. Next, the element is profit and loss operation started non-controlling interest and the profit portion. Next, these income items can be categorized into the four, namely, first, the unusual and infrequent gains or loss. Second, operation discontinued. Third is non-controlling interest. And fourth is earning per share. Unusual and infrequent gains or losses. Unusual and rare types of the gains or losses include first, loss of the received supply properties, equipment, goods, bill, or other tangible asset. Second, gains and losses on the sale of the property that was delivered. And third is gains and losses related to the disaster, fires, flood, and earthquakes. And fourth is gains and losses on the sales of investment in securities. Next. Aborted operation. Operations are started when first the entity continues component of the business that includes both operation and cash flow that are clearly distinguishable. And second, the entities continuing components that represent strategic shift and have a major impact on the entities operation and finance. Not controlling interest. The entities must be disclosed. The allocation of the net income to not controlling the interest minority interest. And owners in the statement of the profit and loss and other comprehensive income, which is located at the bottom of the income statement after the net income item. Next. The allocation of the net profit can be done as follows. First, profit and loss for the period that can be attributed to non-controlling interest and the owners of the parity entities. Second, total profit or losses and other comprehensive income for the period that can be distributed to non-controlling interest and owners of the parent entities. Earning per share is earning per share measuring the amount of the money received from each share of the common stock. The earning per share is things like laba bersih or we call it net profit minus jumlah saham biasa yang beredar, the number of the common share outstanding divided to the membayar dividen or we call it the pay dividends. That's all for
Okay everyone, maybe that's all from us. Thanks for your attention. Assalamualaikum warahmatullahi wabarakatuh.